Good morning. This is January 31st, 2012. I'm Taylor Hudson, joined by Hugh McNaughton. We thank you for joining us for our market brief. We're going to break from the norm a little bit today and provide a general overview for 2012. It's the beginning of the year. We're starting to see a lot of forecasts come out for the year in total. We're fortunate at Sprague to get a lot of commentary that flows through the building, and we'd like our listeners to be able to benefit from some of that as well. So we're going to present our overview of what we're seeing on this commentary. The chart that you're looking at right now is a long-term WTI chart. It's for reference only. It shows price action for U.S. crude oil all the way back to 2008 when we hit the high at $147. The subsequent plunge in 2009 to $32. And today's trading range just around $99 and $100. The midpoint, for those who are interested, is just under 90. So what we'd like to do is start with the overall commentary feel that we're seeing. And unfortunately for petroleum consumers, most of the comments that we see today are on the bullish side of the bull-bear debate. If somebody's coming out and trying to forecast energy prices through the rest of 2012, more than likely they're going to talk about things that are going to shore up pricing rather than erode pricing. First, I want to start with the overall supply and demand outlook for the traditional fundamentalists in the crowd. And when you look at 2012, most economists are projecting demand growth worldwide for crude at about 1.3 million barrels a day. And then who's going to make up for that demand growth? Well, on the non-OPEC side, they're only expecting demand growth of about 800,000 barrels a day. So all of those articles that you read about U.S. Crude oil production rising, while they are true, and we are seeing some supply come online, more from non-conventional type wells around the globe, that still only accounts for about 800,000 barrels a day of growth. So if demand's going up by 1.3, supply from the non-OPEC countries is only going up by 800,000. We still need OPEC to kick in another 500,000 barrels a day. OPEC right now is assumed to be producing just about at the maximum levels they can. Those spare capacity numbers that you see come in somewhere between 2 and 2.5 million barrels a day. So if we didn't have anything else going on in the markets, the economists would still be looking at the energy markets this year as relatively tight and a reduction in OPEC's spare capacity. So for the fundamentalists in the crowd, you're working with a market in 2012 that's tight and expected to get tighter. Underpinning that demand growth assumption is a better economic outlook, even better than what we were seeing at the tail end of 2011. On the U.S. side, we had a decent fourth quarter GDP number that was released. If you take out the government sector, which was a drag on GDP, actually saw fairly significant growth. Jobs data, while it hasn't been as robust as it was coming out of other recessions, is still moving in the right direction. We're going to get our latest report on that this Friday. And finally, consumer and business sentiment indicators on the U.S. side are looking good as well. So when the economists look out at demand growth, they're looking at the U.S. and they're saying, hey, the economy may not be so bad. On the European side, which tended to be the one argument that the bears certainly had in their favor, we've seen a shift over the last 45 days from downright panic to a little bit more comfortable with what's going on in Europe. Number one, the recession that they expect Europe to be in right now and through the rest of 2012 is expected to be milder than first forecast. Confidence levels, business sentiment is actually better than expected. And the big one is there does appear to be some movement towards a solution to the Greek debt crisis. Yes, the banks and the Greek government are negotiating who's going to take what haircut, but negotiations are better than no negotiations, and most of the smart money believes that at some point they will come to an agreement on what to do with Greek sovereign debt. The big guns, however, when folks argue for the economy improving over time, really come from monetary policy and what the central banks around the world are doing. Certainly on the U.S. side, the Fed indicated last week that they are going to continue their low interest rate policies at least through the end of 2014. In the Fed's eyes, even though economic growth looks good right now, unemployment is still way too high. They want to see the unemployment number at 5.5%, and they want to see some signs of inflation. So they do not look at food and energy costs when they calculate inflation. They probably want to see some wage inflation before they get too worried, and there's no sign of that at this point in time. So on the U.S. side, you have the Fed keeping interest rates low, and probably one of the most overlooked and underreported stories at the end of December was the European Central Bank took a play from the Fed's playbook and flooded 489 billion euros to European banks. They allowed them to post collateral that was less than AAA. It was mostly sovereign debt. And they essentially signaled to the market that there would be unlimited loans available for European banks. Now, while some evidence has come out that that money has not been relent, it is shoring up these banks' balance sheets, and that makes financial markets, less jittery than they were just 30 to 40 days ago. When you don't have the Dow moving 200, 300 points a day because they're worried about banks going out of business, that tends to make the economists a little more comfortable with what's ahead in 2012 for demand. So actually I wanted to jump over to Hugh now and talk about sort of the implications of the low interest rate policy going forward on commodities. Hugh?
Well, apart from the economic stimulus aspect of a looser monetary policy, it is the liquidity, which is inevitably going to result in a weaker dollar, that's going to impact most on commodity prices. Commodities priced in dollars, of course, tough for people who use dollars, but not for the 90% of the world that doesn't and buys petroleum in yuan and rupees and yen. And they will, as petroleum gets cheaper relatively for them, their demand for the commodity is going to go up. The second aspect of this is that a weaker dollar encourages investors to put their money in commodities as a hedge against further erosion of the currency. That in turn, of course, makes the dollar even weaker and improves the cost or increases the cost of the commodity.
So the weaker dollar basically means we can't get rid of these speculative hedge funds in the markets, Hugh?
No, it's certainly an encouragement for them to stay in, and we, by golly, they are.
Great. Now, so on the demand side of the equation, we've kind of laid out the arguments for why people think energy prices will remain high. Then the argument shifts over to the supply side. And here, unfortunately, the arguments are primarily in the bull's favor. They deal with that good old word, geopolitics and geopolitical risk. Let's talk about that for a little bit, Hugh. What are the major ones on that side of the board?
I guess you've got two of them really here. You've got Iran with this continuing saber rattling, whether they ever intend to use it or not, Taylor. But unfortunately now, increasing indications that Iraq is deteriorating and possibly even to the extent of moving towards a civil war. And both of those are pushing emphasis on the last remaining cushion of surplus capacity, which is Saudi Arabia. And as that cushion shrinks, of course, the more fundamental support there is from a supply standpoint.
How about Libya? What's going on with Libya lately?
Well, it's coming back, but nowhere near the rate that I think analysts expected. Libya produced 1.6 million barrels before the civil war. It's now anticipated that it will be up to 1.2 by the end of 2012, but it's still a lot slower than originally expected.
Finally, I want to spend a little bit of time on all this refinery news that we've heard lately, especially in the Atlantic Basin. We have refiners on the East Coast as well as in the Caribbean shuttering operations. And in Europe, we have some problems there as well. How should we read this news, Hugh? Is this the type of story that is going to cause the markets to go up 5 or 10 cents in one particular day, or is it something a little more subtle and long term? How should we read this refining news?
I think it will be much more of a subtle influence on future market values. What it's doing is two things. It's reducing the diversity of supply into the U.S. East Coast, which of course makes the petroleum market here more vulnerable to basis spikes or to potential temporary maybe shortages. The other thing in the longer run is that it's increasing the supply lines, and therefore the costs. We'll need more gasoline from Europe. We'll need, which is a very adequate supply at about 1 million barrels a day, but we will need more supplemental supply on the distillate side up the Colonial Pipeline from the Gulf Coast, which is the only other consistent source of supply. Both of those are going to make the East Coast market a little bit more vulnerable to potential increased costs.
All right, well, there you have it, folks. Hopefully a brief enough view of what the major factors driving the market are for 2012. On this side of the table, we see most analysts pointing to steady to higher pricing, and these are the reasons why. We encourage your feedback. Thank you very much for your participation today. We hope you have a wonderful day. Thank you.